respected viewers, dear family of seekers, beloved souls walking the path of wisdom and abundance. There is a moment that comes every year, a moment when the air shifts, when the calendar turns, when the world prepares to close one chapter and begin another. And in that moment, in that sacred transition between what was and what will be, fortunes are made and lost, not by chance, not by luck, but by understanding, by vision, by the courage to see what others cannot. December has arrived, and the whispers on Wall Street tell a curious tale. Investors are sitting on cash, positions are light, portfolios are cautious, and everyone is asking the same question. Will there be a year-end rally? Should I wait? Should I act? Should I trust what history suggests or fear what uncertainty threatens? But here's what most people miss. The question itself reveals the problem. Because when you're asking whether to chase a rally, you've already lost the game. The real question, the question that separates the wealthy from the worried, is this: do you understand the market, or are you trying to time it? You know, I've watched this dance play out for decades. Every November, every December, the same pattern. The market does something. People react. Fear rises. Greed awakens. And in the chaos, the patient few build wealth, while the anxious many chase shadows. Let me tell you about a man I knew. His name was David. December of 2008. The world was falling apart. The financial crisis had devastated portfolios. Banks were collapsing. Companies were going bankrupt. And David was sitting on a pile of cash he'd saved for years. His friends told him to wait. The market could go lower, they said. Don't catch a falling knife, they warned. This time is different, they insisted. And David, he listened. He waited. December passed. January came, then February, then March. And the market did go lower. His friends felt vindicated. Say you would have lost money. But then something happened. The market turned. Not with warning, not with permission. It just turned. And it climbed. And climbed. And by the time David felt safe enough to invest, the biggest gains were already gone. He bought in eventually, made some money. But he missed the extraordinary opportunity that fear had blinded him to. He missed the moment when assets were priced for apocalypse, when the best businesses in the world were trading at absurd discounts, when everyone else was panicking. And for the rest of his life, David remembered that lesson, not because he lost money, but because he lost opportunity. And opportunity is the most expensive thing you can lose. Now here we are, December 2024. And the narrative is different, but the psychology is the same. Investors are underweight equities. They're holding cash. They're waiting for something. Clarity, maybe. Certainty. A sign from above that says now is the time. But the market doesn't send invitations. The market doesn't wait for you to feel ready. The market rewards those who understand value, not those who chase comfort. So let me ask you something, and I want you to really think about this. When you look at the market right now, what do you see? Do you see risk, uncertainty, reasons to wait, or do you see opportunity, value? Businesses trading below their intrinsic worth because others are too fearful to recognize it. Because the truth is, both are there. Both are always there. Risk and opportunity exist simultaneously. The question is, which one are you trained to see? I remember a woman named Sarah, a brilliant investor, who taught me something profound about year-end markets. She told me this story sitting in her modest office, surrounded by books and charts and decades of wisdom. December, she said, is when the amateurs panic and the professionals position. Because the amateurs are thinking about this year. Their gains, their losses, their taxes, their emotions. But the professionals, they're thinking about next year, next decade, the long game. Sarah had a ritual every December. She'd review her portfolio, identify undervalued positions, and quietly accumulate them while others were distracted by holiday shopping and year-end reviews. No drama, no headlines. Just patient, disciplined buying of quality assets at reasonable prices. Over 30 years, this simple approach had made her extraordinarily wealthy. Not because she caught every rally, not because she timed every bottom, but because she understood something most people never learn. The best time to invest is when you have conviction, not when you have certainty. Certainty is expensive. By the time everyone is certain, prices reflect that certainty. The opportunity is gone. The early advantage has evaporated. You're buying what's popular, not what's valuable. But conviction is different. Conviction comes from understanding, from research, from knowing what a business is worth regardless of what others think today. Conviction allows you to act when prices are attractive, even if the crowd is skeptical. And right now we have a fascinating setup. Investors are light on stocks. Sentiment is cautious. Cash positions are elevated. And historically, when retail investors are underweight and fearful, that's often when the next move higher begins. Not always. History doesn't repeat perfectly, but it rhymes. And the rhyme suggests that when everyone is positioned for safety, when pessimism outweighs optimism, when cash levels are high and equity exposure is low, the market tends to surprise to the upside. Why? Because markets don't reward the consensus. Markets reward those who position ahead of the consensus. And right now the consensus is cautious. Let me tell you about the December effect, because it's real and it matters. For decades, December has been statistically one of the strongest months for equity returns. Not every December, but on average, the data is clear. Something happens in December that tilts odds in favor of gains. Some people attribute it to Santa Claus rallies. Others point to tax loss harvesting creating buying opportunities. Others note that fund managers window dress their portfolios buying winners to show at year-end. Others suggest it's simply seasonal optimism and holiday spending boosting sentiment. The reasons matter less than the pattern, and the pattern is undeniable. December, on average, rewards equity holders. But here's where it gets interesting, and this is crucial. The December effect works best when investor positioning is light. When everyone is already fully invested, there's less fuel for a rally. But when investors are holding excess cash, when they're underweight stocks, when they're nervous, there's dry powder. Potential energy waiting to convert to kinetic energy. And that's exactly where we are. I think of a young investor named Michael. He was 28 when I met him. December of his first full year of serious investing. He'd done well through the year, built a modest portfolio, felt proud of his progress. Then December came, and he read an article predicting a market correction, another article warning of recession, another suggesting investors should take profits and wait. Michael got scared. He sold half his positions, moved to cash, told himself he was being smart, cautious, responsible. And then December delivered an 8% gain. His portfolio, now half in cash, captured only 4%. His friends who stayed invested, full 8%. Worse, when January came and the market kept climbing, Michael didn't know when to get back in. He waited for a pullback that never came, and by the time he finally reinvested out of frustration, he'd missed an additional 5%. That one decision, that one moment of succumbing to fear in December, cost Michael years of compounded returns. Not because he made a catastrophically bad decision, but because he broke the cardinal rule of long-term investing: stay in the game. Because here's what they don't teach you in finance classes. The biggest risk isn't being invested when the market falls. The biggest risk is being out of the market when it rises. Markets spend most of their time going up, slowly, steadily, with occasional sharp drops. But the overall trajectory over time is upward. And if you're not invested during the upward moves, you miss the entire point of equity investing. People focus so much on avoiding losses that they forget missing gains is also a loss, an invisible loss, a lost opportunity. And lost opportunities compound negatively just as surely as realized gains compound positively. I watched this happen to a successful attorney named Richard. Smart man, great career, made excellent money, but he was perpetually scared of the market, always finding reasons to wait, always seeing clouds on the horizon. December after December, he'd sit on cash. I'll invest when things are clearer, he'd say, when the economy stabilizes, when valuations are more attractive, when I feel confident. But things never got clearer. The economy never stabilized enough. Valuations never felt quite right, and his confidence never arrived. 20 years of waiting. 20 years of missing the greatest bull market in modern history. 20 years of cash earning nothing, while the market multiplied wealth for those who participated. When Richard finally looked at the numbers, when he compared what he had versus what he could have had, the realization broke him. Not financially, emotionally, because he understood he'd let fear steal his future. And the tragedy, the absolute tragedy, he didn't lose money to a bad investment. He lost wealth to no investment, to paralysis, to waiting for perfect conditions that never come. This is the lesson I want you to absorb deeply, truly deeply. Perfect conditions don't exist. Ideal entry points are only obvious in hindsight. Certainty is an illusion that costs you opportunity. The market is always climbing a wall of worry, always facing uncertainties, always giving you reasons to wait. And if you wait for those reasons to disappear, you'll wait forever. So what do? How do you navigate this December? This moment of decision, this fork in the road where one path leads to participation and the other to spectating. You ask yourself not what might happen next week or next month, but where you want to be 5 years from now, 10 years, 20 years. Because if your horizon is long, if you're investing for wealth rather than trading for profits, then the question isn't whether December will rally. The question is whether the businesses you're investing in will be worth more in the future than they are today. And if the answer is yes, then the price you pay today matters less than the patience you exercise tomorrow. I knew a couple, Thomas and Emma. They started investing in their 30s. Nothing fancy, just broad market index funds. But they had a rule, a sacred rule they never broke. They invested the same amount every month. December or June, bull market or bear, rally or correction, didn't matter. Same amount, every month, no exceptions. Their friends thought they were crazy during bad Decembers. Why are you buying when the market's falling? During good Decembers, same question, different fear. Why are you buying when the market's at all-time highs? But Thomas and Emma understood something profound. They weren't trying to time the market. They were trying to own it. And the best way to own it, consistently, relentlessly, without emotion. 30 years of this approach through crashes and booms, through recessions and expansions, through fear and greed. Same strategy, same discipline, same commitment. And when they retired, their portfolio was worth over $3 million. From consistent monthly investments that started at just $500 and grew as their income grew. No market timing, no clever trades, no panic selling, no greed buying, just consistency. The most boring, most reliable, most powerful strategy in all of investing. This is what I want you to understand about this December, about any December, about any moment when you're wondering whether to act or wait. If you're investing for the long term, if you're building wealth rather than chasing returns, if you're focused on decades rather than days, then December is just another month, another opportunity to add to quality positions, another step on a journey that spans years, the year-end rally. It might happen, it might not. History suggests it's more likely than not. But it doesn't matter, not really, not to the patient investor. What matters is that you're invested in quality businesses at reasonable prices. What matters is that you're consistently adding to those positions. What matters is that you're thinking in years while others are reacting to weeks. Because wealth, real wealth, isn't built on catching rallies. It's built on staying invested, on compounding, on letting time do its work. I think about all the investors I've known who spent their lives chasing the next hot stock, the next big rally, the next perfect entry point. Always moving, always adjusting, always convinced the next trade would be the one. And you know what? Almost all of them underperformed. Not because they weren't smart, but because they couldn't sit still. They couldn't let compounding work. They couldn't resist the siren song of action. Compare that to the investors who bought quality and held, who ignored the noise, who stayed invested through December's good and bad, who trusted their research and their patience. Almost all of them built significant wealth, not quickly, not dramatically, but surely, steadily. Inevitably, this is the path, this is the way. Not sexy, not exciting, not something you can brag about at parties, but effective, proven, reliable. So as we enter this December, as the questions swirl and the predictions fly and the uncertainty looms, I invite you to take a breath, to step back, to remember why you're investing in the first place. You're not investing to catch a December rally. You're investing to build a life of financial freedom. And that life, that beautiful, peaceful, abundant life, it's built 1 month at a time, 1 year at a time, 1 decade at a time. December is just one more brick in that foundation. And the question you must ask yourself is not, will December rally? But rather, am I building something that will last? Because here's what I've observed over all these years. The investors who obsess over monthly performance, who agonize over every market movement, who constantly question their positions, they're exhausted. perpetually stressed, never at peace. But the investors who understand they're building wealth over decades, they sleep well, they make clear decisions, they have a calmness that comes from knowing, truly knowing, that short-term volatility is just noise in a long-term symphony. Let me share something personal, something I learned the hard way. Early in my investing life, I was obsessed with being right, with timing markets perfectly, with maximizing every opportunity. December would come and I'd analyze every data point, every indicator, every prediction, trying to determine if I should be more aggressive or more defensive. And you know what all that analysis got me? Paralysis, confusion, and performance that was mediocre, because I was so busy trying to be clever that I forgot to be patient. Then something shifted. I read about a study that looked at the best performing portfolios over a 20-year period. And you know which portfolios performed best? The ones belonging to people who had forgotten they had them. Dead people. People who literally couldn't trade even if they wanted to. Their portfolios just sat there, compounding, growing, uninterrupted by fear or greed or the need to do something. That study changed everything for me, because it revealed a truth most people can't accept. In investing, doing nothing is often the hardest and most profitable action you can take. Now, I'm not suggesting you invest blindly and forget about it entirely. You need to review, to rebalance, to ensure your holdings remain sound. But the constant trading, the constant adjusting, the constant second guessing, that's not management. That's anxiety masquerading as activity. And in December, when everyone's talking about year-end rallies and positioning and what to do, the anxiety intensifies, because there's this sense that you need to make a decision, that doing nothing is somehow irresponsible. But sometimes, often, doing nothing is the most responsible choice you can make. I knew a fund manager named Patricia, brilliant woman, decades of experience, and she had this philosophy that drove her colleagues crazy. She called it strategic laziness. Patricia would identify undervalued companies with strong fundamentals. She'd build positions, and then she'd do nothing, for years sometimes, while others were trading in and out, chasing momentum, trying to optimize every move Patricia just held. Her colleagues mocked her, called her work ethic questionable, suggested she wasn't adding value. But year after year, her returns outperformed theirs, not because she was making brilliant trades, but because she was avoiding stupid ones, not because she was constantly active, but because she was selectively patient. And December was her favorite month, because while everyone else was scrambling, rebalancing, tax loss harvesting, chasing year-end performance, Patricia was on vacation, literally. She'd close her laptop the first week of December and not open it until January. "The market doesn't need me watching it," she'd say, "and I don't need the stress of pretending I can predict what it will do." That confidence, that peace, it came from understanding something fundamental. She wasn't trying to beat the market every month. She was trying to capture its long-term returns, and those returns, they accrue to the patient, not the clever. Now let's talk about what's actually happening right now, because context matters, understanding matters, and making informed decisions requires seeing the full picture. Investors are underweight stocks heading into December. That's a fact. But why? What's driving this caution? Some of it is profit-taking. People had gains through the year and they're locking them in. Reasonable. Understandable. Some of it is uncertainty about interest rates, inflation, economic growth. Valid concerns. Real factors that impact valuations. Some of it is simply exhaustion. The market has been volatile. People are tired. They want to end the year with less stress. All of these reasons make sense individually. But collectively, they create a setup where positioning is light, sentiment is cautious, and expectations are muted. And in markets, when expectations are muted, when positioning is defensive, when consensus is cautious, that's often when surprises happen. Positive surprises. Not because the market is trying to trick people, but because markets are forward-looking mechanisms that price in collective expectations. And when those expectations are low, there's room for pleasant surprises to drive prices higher. Think about it this way. If everyone expected a massive December rally, if investors were heavily long, if sentiment was euphoric, what would drive prices higher? Everyone who wanted to buy would have already bought. There'd be no new buyers, no fuel for the fire. But when people are cautious, when they're holding cash, when they're waiting for clarity. That's when there's buying power on the sidelines. That's when positive news or improving data can trigger a rush of capital into equities. It's not guaranteed. Nothing ever is. But the setup is intriguing. I think of a conversation I had with an economist friend of mine. We were discussing market dynamics, and he said something that stuck with me. Markets, he said, are like compressed springs. The more they're pushed down by pessimism, the more energy they store. And when sentiment shifts even slightly, that energy releases, sometimes violently, and right now the spring feels compressed, not fully, not to crisis levels, but compressed enough that a shift in sentiment could release significant upward energy. Does that mean you should rush in, buy everything, max out your positions? No, not at all. That's the trap of trying to time markets. The trap of greed masquerading as opportunity. What it means is, if you have conviction in quality businesses, if you've done your research, if you understand intrinsic value, then being underweight stocks out of fear of what December might do. That's probably a mistake, because you're making a market timing decision. You're betting that you can get out, wait for clarity, and get back in at better prices. And historically, that bet fails more often than it succeeds. Let me tell you about James, a retiree living on his investment portfolio. Every December he'd get nervous. The year-end uncertainty would trigger his anxiety, and he'd reduce his equity exposure, just to be safe. On most years, nothing dramatic happened. Market went up, went down, ended somewhere reasonable, and James would congratulate himself for being cautious. But over 10 years, those 10 Decembers of being safe, they cost him hundreds of thousands of dollars in missed gains. Because more often than not, December was positive, and he was in cash or bonds during those positive moves. The few years December was negative, he avoided some losses, maybe $20,000 or $30,000 total, but he missed gains of $300,000 or $400,000. The math was brutal. His caution had cost him enormously, not because being cautious is wrong, but because he was being tactically cautious in a way that undermined his strategic goals. And when James finally understood this, when he finally calculated the cost of his December defensiveness, he wept. Not from the money lost, though that hurt, but from the realization that his fear had been more expensive than any market correction. This is what I want to protect you from. Not from making mistakes. We all make mistakes, but from making the same expensive mistake repeatedly without realizing it. Being cautious feels safe. Reducing exposure feels responsible. Waiting for clarity feels prudent. But if you're doing it every December, every correction, every time uncertainty rises, you're not being prudent. You're being reactive. And reactive investors over time underperform patient investors. So what should you do right now, this December, with this information, with these market conditions? First, breathe. Step back from the noise. Turn off CNBC. Stop reading prediction articles. Give yourself space to think clearly. Second, review your actual financial plan. Not what you think you should do, but what your plan says, what your time horizon requires, what your risk tolerance allows. If your plan says you should be 70% in equities, then be 70% in equities. Not 65 because you're nervous about December. Not 75 because you're excited about a possible rally. 70, according to your plan. Third, if you have cash that should be invested according to your plan, invest it. Not all at once if that feels reckless. Dollar cost average over the month. But get it working, because cash sitting on the sidelines isn't being prudent. It's being expensive. Fourth, if you're properly allocated and invested in quality holdings, do nothing. Seriously, nothing. Let your investments work. Let time compound. Let the market do what markets do. And fifth, if you're feeling overwhelmed, if the uncertainty is genuinely causing you stress, that's information. That's telling you something about your risk tolerance. Maybe you're overexposed for your personality. Maybe you need to adjust your overall allocation. But do it strategically with a plan, not reactively because of 1 month. These aren't exciting recommendations. They won't make you feel like a genius trader. They won't give you bragging rights at holiday parties. But they work, consistently, reliably, across decades and market cycles. I watched a young couple, Daniel and Maria, follow this exact approach. They were in their 30s when they started, set up an investment plan based on their goals and timeline, committed to it, and then just executed it month after month. year after year. December would come and their friends would be panicking or celebrating or predicting or adjusting. Daniel and Maria. They'd invest their regular amount and go enjoy the holidays. No stress, no agonizing, no FOMO, no fear, just consistency. 20 years later, they retired early, financially independent. Not because they caught every rally, not because they avoided every correction, but because they stayed invested and let compounding work its magic. And when people asked them their secret, they didn't have some complex strategy to share. They just said, "We had a plan and we stuck to it." Simple, boring, profoundly effective. Now I want to address something else, something that's particularly relevant this December. The psychological weight of the calendar year ending. There's something about December 31st, something about closing one year and opening another. It creates this artificial sense of conclusion. Like whatever happens this year is final, like your investment results are graded on an annual basis. But that's not how wealth building works. Your portfolio doesn't reset on January 1st. Compounding doesn't pause for New Year's Eve. The businesses you own don't suddenly change value because the calendar changed. And yet people treat year end like a report card. They calculate their annual returns, compare them to indices, feel good if they outperformed, feel bad if they underperformed, and then they make decisions based on those feelings. I had a great year, I should take some profits. I had a bad year, I should try to make it up. I'm up 10%, I'll lock that in. I'm down 5%, I need to recover. All of these are emotional reactions to arbitrary time periods. And emotional reactions, they're expensive. I knew an investor named Helen. Every December she'd calculate her annual returns. And if she was up more than 15%, she'd sell a portion to lock in gains. If she was down, she'd buy more aggressively to average down. That sounds reasonable, right? Almost disciplined. But here's what happened the year she was up 15%. Often the market was up 25%. By selling, she missed the continuation. The year she was down, often the market was bottoming. By buying more aggressively, she doubled down on positions that had declined for good reasons. Over 15 years of this strategy, Helen significantly underperformed simply buying and holding, all because she was making decisions based on calendar, year performance rather than fundamental value. The lesson: the calendar is a tool for organizing your life, not for organizing your investment strategy. Your investment horizon is likely decades. Your returns should be measured over those decades, not year by year, not month by month, not certainly based on what happens in December. I want you to imagine something. Imagine you're planting an orchard. You plant young trees. You water them, care for them. And at the end of the first year, you measure their growth. Some grew 6 inches. Some grew 8. Some grew only 4. Would you cut down the ones that grew 4 inches? Would you plant more of the ones that grew 8? Or would you understand that young trees grow at different rates, that 1 year tells you almost nothing, that what matters is giving them time to mature? Your portfolio is that orchard, and December is just 1 month in 1 year of a multi-decade growing season. The trees that grew less this year might explode next year. The ones that grew most might consolidate, or all of them might grow steadily for decades, and yearly variations become meaningless noise. This perspective, this long-term, patient, orchard keeper perspective, it's what separates wealthy investors from stressed investors. Wealthy investors understand time is their ally. Stressed investors feel time is their enemy. Wealthy investors give their investments room to grow. Stressed investors demand immediate validation. And December reveals which camp you're in. Are you anxiously checking positions, calculating year-end returns, wondering if you should adjust, feeling pressure to do something? Or are you calm, confident in your holdings, focused on decades rather than days, able to enjoy the holidays without portfolio anxiety? Your answer tells you everything about whether you're investing or just gambling with long-term money. There's a beautiful freedom that comes when you truly internalize this, when you stop treating investment results like test scores, when you stop comparing yourself to indices and neighbors and headlines. The freedom to just be invested, to let your money work, to trust the process, to live your life while your wealth compounds quietly in the background. I've been blessed to know many wealthy people over my lifetime. And here's what I've noticed: the wealthiest ones spend the least time thinking about their portfolios. not because they don't care, but because they set them up correctly from the start and then let them work. The stressed, anxious ones. They're constantly watching, adjusting, trading, reacting. And ironically, they're usually less wealthy because all that activity creates costs, taxes, fees, mistakes, missed opportunities. There's a wisdom in stillness that most people never discover, a power in patience that outperforms cleverness. And this December you have an opportunity to practice that stillness, that patience, that trust. The markets will do what they do. December may rally. It may not. Other investors may profit more than you this month or less. None of it matters. Not really. Not in the grand scheme of building lasting wealth. What matters is whether you're staying true to your plan, whether you're maintaining discipline, whether you're thinking like an owner of businesses rather than a trader of stocks. Because here's the truth that took me years to fully understand. The stock market isn't a casino where you're betting on outcomes. It's a marketplace where you're buying ownership in real businesses. And those businesses, they're operating every single day, creating value, serving customers, generating cash flow. The price at which their shares trade on any given day, that's just the market's collective opinion. And opinions are fickle, emotional, often wrong. But the underlying business value, that's real, that's tangible. And over time, over sufficient time, price converges with value, always, without exception. This is why the year-end rally question is the wrong question. The right question is, are the businesses I own worth more than I paid for them? And will they be worth even more 5, 10, 20 years from now? If the answer is yes, then whether December rallies or corrects becomes irrelevant noise. Let me tell you about an experience that crystallized this for me. I once met a farmer, an old man who'd spent his entire life working the land. He had a small portfolio of dividend-paying stocks, nothing fancy, just shares in a few solid companies he'd accumulated over decades. I asked him how he thought about investing, how he decided when to buy or sell, whether he worried about market movements. He looked at me like I'd asked the strangest question. And then he said something I'll never forget. I don't think about investing the way you finance people do. I think about it like farming. I plant seeds. I tend the crops. I harvest when they're ready. The weather changes day to day, storms, sunshine, drought, rain. But I don't pull up my crops every time the weather shifts. I trust the seasons. I trust the process. And at the end of the year, I have a harvest. He paused, then smiled. Some years the harvest is bigger, some years smaller. But over a lifetime, I've fed my family, built something real, left something for my children, not by being clever, by being patient. That conversation changed how I see everything, because he was right. Investing isn't about outsmarting markets. It's about participating in economic growth over time. It's about owning pieces of productive assets and letting them do what productive assets do, produce. And December is just weather. Sometimes sunny, sometimes stormy. But the crops don't care what month it is. They just keep growing. Now, I want to talk about something that's been weighing on many investors' minds. The specific dynamics of this December. The fact that positioning is unusually light. That uncertainty feels particularly acute. That the headlines are filled with reasons to worry. Interest rates, inflation, geopolitical tensions, economic data, political uncertainty. The list goes on, and all of these concerns are valid, real, worth considering. But here's what history teaches us. There has never been a time when the list of concerns was empty. Never. In all of market history, there has always been something to worry about. In the 1970s, it was stagflation and oil crisis. In the 1980s, it was recession and Cold War tensions. In the 1990s, it was tech bubbles and Y2K fears. In the 2000s, it was terrorism, financial crisis, wars. In the 2010s, it was sovereign debt, Brexit, trade wars. And through all of it, through every crisis, every uncertainty, every reason to stay in cash, the market climbed. Not in a straight line. Not without painful corrections. Because the market isn't pricing in perfection. The market is pricing in progress. Imperfect, messy, 2 steps forward, 1 step back progress. But progress. And the businesses that comprise the market, they're run by smart people who adapt, who innovate, who find ways to create value even in challenging conditions. This is why waiting for perfect clarity is such a costly mistake. Perfect clarity never comes, and by the time conditions feel safe, you've already missed the recovery. I watched this happen to a colleague of mine, a very intelligent economist named Robert. He had this theory that markets were overvalued in 2010, that we needed a correction, that the recovery from the financial crisis was artificial and wouldn't last. So he sat in cash waiting, analyzing, predicting when the inevitable collapse would come. 2010 passed. Any day now, Robert said, 2011, market flat. See, I was right to wait to 2012. Market up 20%. This is irrational exuberance. Can't last. 2013. A bubble. Definitely a bubble. Years went by. Robert's predictions never materialized. Or when they did briefly, the market recovered before he could capitalize. And by 2020, when he finally gave up and invested, he'd missed over 200% returns. 200%, because he was smarter than the market, or thought he was. The tragedy of Robert's story isn't that he made a bad prediction. We all make those. The tragedy is that he let his prediction override the most basic principle of long-term investing. Stay invested in quality assets and let time work. He was so focused on being right about a correction that he forgot about being wealthy. And there's a big difference between being right and being wealthy. Markets can remain irrational longer than you can remain liquid. Markets can climb walls of worry for years. Markets can defy logic and predictions and expert analysis. But markets, over time, reward owners, not predictors, owners. So this December, as you hear predictions about rallies and corrections, as you see headlines about positioning and sentiment, as you feel the pull to do something, remember Robert. Remember that being clever is expensive, that predicting is dangerous, that the safest path, the most reliable path, is to own quality businesses and hold them through all the Decembers that come. Let me share one more story, because I think it ties all of this together. There was a janitor, a man named Ronald Reed. He worked his entire life in rural Vermont, never made much money, lived modestly, drove the same old car for decades. You'd walk past him on the street and never give him a second thought. Ronald died in 2014. And when his will was read, people were shocked. This janitor, this simple man living a simple life, had accumulated over $8 million. $8 million. From a janitor's salary. How? Not through luck. Not through a lottery. Not through some secret strategy. He bought stock in quality companies, blue-chip dividend payers, and he held them. For decades, through countless Decembers, through rallies and crashes, through good years and bad, he reinvested dividends. He added to positions when he could, and mostly he just let time do its work. No Harvard MBA, no sophisticated analysis, no market timing, just patience, discipline, and an understanding that ownership of productive assets, given enough time, creates wealth. Ronald Reed's story is the answer to every question about December rallies, market timing, and optimal positioning. The answer is it doesn't matter. None of it matters compared to the power of long-term ownership and compounding. Will December rally? Maybe, maybe not. But in 40 years of holding quality businesses, does one December matter? Does it change the trajectory of compound growth? It doesn't. It really doesn't. And yet people will stress about it, agonize over it, make decisions based on it. And in doing so, they'll miss the forest for the trees. The forest is this: if you own good businesses at fair prices, and you hold them for decades, you will build wealth. The trees are the daily and monthly movements that distract you from this truth. So as we close out this conversation about December, about positioning, about year and rallies, I want to leave you with a challenge to rise above the noise, to think bigger than 1 month, to focus on what really matters. Ask yourself 10 years from now, will I remember what happened in December 2024? Will it matter to my wealth whether the market was up 5% or down 3% this month? Or will what matters be that I stayed invested, that I remained disciplined, that I trusted the process and gave compounding time to work? You know the answer. Deep down, you know it. December is just another month, and the best way to approach it is the same way you should approach every month. Review your plan. Ensure you're properly allocated. Invest according to your strategy. And then live your life. Stop checking your portfolio every day. Stop reading prediction articles. Stop letting market movements dictate your emotional state. You're not a day trader. You're not a hedge fund manager trying to beat benchmarks. You're a person building long-term wealth so you can live the life you want. And that life, it's not lived staring at screens and obsessing over December's performance. It's lived with family and friends, pursuing passions, creating memories, contributing to the world. Your money should enable that life, not consume it. And the way to ensure your money works for you rather than you for it is to set up your investments correctly and then let them be. I think about the hours, the thousands of hours I wasted early in my investing life, watching tickers, reading news, analyzing charts, trying to be clever. And you know what all those hours got me? Returns that were mediocre, and a life that was stressed. Compare that to later, when I finally understood, when I built a portfolio of quality businesses I believed in, and then just held them, checked on them quarterly, made minor adjustments rarely, and spent my time on things that actually mattered. Returns improved dramatically. And more importantly, life improved. Because I wasn't a prisoner to market movements anymore. I was free to think, to create, to enjoy, while my investments quietly grew in the background. That's the goal, that's the destination. Not outsmarting markets, not catching every rally, but building a system that works without consuming your peace of mind. And this December is an opportunity to practice that approach, to demonstrate to yourself that you can remain calm while others panic, that you can stay invested while others flee, that you can trust your plan while others abandon theirs, not because you're ignoring risk, not because you're being reckless, but because you understand something they don't. You understand that wealth is built slowly, that markets reward patience, that trying to be clever usually makes you poor. And you understand that the best investment decision you can make this December is the same decision you should make every December. Stay the course. Trust the process. Think in decades. Everything else is noise. I want to close with this thought because it's something that's brought me great peace over the years. The market doesn't care about you. It doesn't care about your timeline, your needs, your emotions, your predictions. It's going to do what it's going to do. And that's actually liberating, because it means you can stop trying to control it, stop trying to predict it, stop trying to outsmart it. You can just participate in it, own pieces of it. Let it do what it does while you do what you do. And over time, over the long, patient, disciplined time that most people don't have the stomach for, you'll build wealth. Not through brilliance, through endurance, not through timing, through time, not through prediction, through participation. This December, like every December before it and every one that will come after, is just another month in a lifetime of months. Another opportunity to practice patience. Another chance to demonstrate discipline. The market will move. Prices will fluctuate. Headlines will predict. Experts will opine. And you'll stay invested. You'll remain calm. You'll trust your plan because you're not trying to win December. You're trying to win the decades. And decades are won by the patient, the disciplined, the ones who understand that the tortoise always beats the hare. So let others chase rallies. Let them time markets. Let them stress about positioning and sentiment and year-end performance. You'll be quietly building wealth, 1 month at a time, 1 year at a time, 1 decade at a time, until one day you'll look back and realize that you won, not by being the smartest, but by being the most patient. And that victory, that quiet, understated, profound victory, it's sweeter than any December rally could ever be.